Last year, when the tax bill arrived, I wasn't surprised. Disappointed, yes, but not surprised. Many of us are retired now. We rely on Social Security, maybe a pension, maybe a little retirement income. And yet, every year, the taxes still seem heavier than expected. This year, there is a change worth knowing about. If you are 65 or older, there is a new $6,000 senior tax deduction. If you are married, and both of you qualify, that amount can be $12,000. It is new. It is easy to overlook, and no one will personally notify you. So today, I want to clearly explain what it is, who qualifies, and what you should verify before filing your return. This is not a tax credit. It is a deduction. It began with the 2025 tax year, which we file in 2026. You may see it referred to by different names, but most people simply call it the $6,000 senior tax deduction. What matters is how it works. This deduction is applied in addition to the standard deduction and the existing extra deduction. For being over age 65, nothing is replaced. Nothing is taken away. Your taxable income is simply reduced further. And when taxable income goes down, the amount of federal tax owed often goes down as well. For many seniors, this reduction can also lower the portion of Social Security benefits that are subject to federal tax. It does not automatically eliminate those taxes, but for many people, the difference can be meaningful. Before we move on, let's talk about something practical. How much does this actually save? I'll use a simple example. Let's go back to Robert. Robert is single. His total income is $50,000. Last year, before this new deduction, his total deductions were roughly $18,500. That left him with about $31,500 in taxable income. At the 12% tax bracket, his federal tax came out to around $3,780. Now let's look at this year. Same income. Nothing else changed. But now, with the new $6,000 senior deduction, his total deductions rise to about $24,500. That brings his taxable income down to $25,500. His federal tax drops to about $3,060. That's a savings of around $720. $700. That is groceries for a month, or several utility bills. For a married couple receiving the full $12,000 deduction, the savings can be around $1,400, depending on their tax bracket. This is not a loophole. It is a straightforward reduction. And for many seniors, it makes a real difference. There are 3 conditions. First, age. You must have been 65 or older by December 31, 2025. A birthday late in the year still counts. Second, Social Security numbers. You must have a valid Social Security number. If you are married and filing jointly, your spouse must as well. Third, income limits. This deduction is intended for seniors with low to moderate income. If you file as a single taxpayer and your income is under $75,000, you may qualify for the full deduction. If you are married filing jointly and your income is under $150,000, the same applies. If income exceeds those levels, the deduction does not disappear immediately. It gradually decreases and may be reduced or eliminated at higher income levels. When income is mentioned here, it refers to modified adjusted gross income, often abbreviated as MAGI. This is the figure near the front of your tax return that your preparer usually highlights. Many seniors fall within these ranges, but each situation is different, which is why it is important to check. This deduction applies whether you take the standard deduction or itemized deductions. That is unusual, and it works in favor of the taxpayer. However, one point is critical. You should not assume this deduction has been applied automatically. It is new. Tax software can overlook it. Preparers can miss it. When filing, verification matters. If you use tax software, confirm that the senior deduction appears. If you work with a tax preparer, ask directly, did you include the new $6,000 senior deduction on my return this year? That question alone can prevent a costly omission. This deduction is not permanent. Under current law, it is scheduled to remain in effect through the 2028 tax year. It may be extended. It may not. At this time, the years 2026, 2027, and 2028 are the years we can count on. If you qualify during this period, it is reasonable to take advantage of it. I want to answer one question that comes up again and again. I'm 64 right now, but I turn 65 later this year. Do I qualify? The answer is yes. As long as you turn 65 by December 31, 2025. It does not matter if your birthday is in January or at the very end of December. If you reached age 65 by the end of the year, you can claim the deduction. When you file, that date, December 31, is the one that matters. To summarize, if you are 65 or older and your income falls within the limits discussed, this deduction is worth confirming before you file. It is not complicated, but it does require attention. I share information like this because many of us prefer clarity over noise. If this explanation was helpful, you may choose to like the video or subscribe to the channel. I focus on practical information for seniors who want facts, not headlines. Next week, the topic will change. Nana Rose will be in the kitchen, sharing simple, nourishing recipes designed for older bodies and realistic routines. Thank you for watching. I will see you next time.